January 17, 1980. Silver hit $49 an ounce. The average American home is worth $47,000. Do the math. 959 ounces of silver buys a house. 1,000 ounces of physical metal is the equivalent of owning a home. Fast forward to today. The median home price in the U.S. is $417,000. Silver is $31 an ounce. It takes 13,451 ounces to buy the same house. The ratio has skyrocketed from 1,000 ounces to over 13,000. But here's what no one tells you. This ratio is about to reverse dramatically, and when it does, people who own 1,000 ounces of silver will be able to trade it in for a house again. Not because silver is going up, not because houses are getting cheaper, because the entire monetary system that created this imbalance is collapsing. And the math doesn't lie. I'll prove it to you using historical data that Wall Street doesn't want you to see. Using the silver-to-home ratio, which has predicted every major wealth transfer in American history, and using current market signals that scream that this pullback is already beginning. By the end of this video, you'll understand exactly why this ratio exists, why it matters, and why people who position themselves now will accumulate wealth for generations, while everyone else watches their purchasing power evaporate. This isn't theory. This isn't speculation. This is pattern recognition, backed by 150 years of data. And this pattern is about to repeat itself. Let me start with a question. What is money actually worth? Not what the number says, not what the government prints on it. What does it actually buy? That's the only measurement that matters. And for thousands of years, humanity measured wealth not in paper, but in how many ounces of precious metal you owned. Because metal is real. Metal is finite. Metal doesn't disappear when governments collapse or currencies fail. And the relationship between silver and housing has been one of the most stable ratios in all of human civilization, until very recently. Let's go back, way back. Ancient Rome. A Roman soldier earned roughly 1 ounce of silver per day. That's where the word salary comes from. Salarium, salt and silver money. A modest home in Rome during the height of the empire cost between 500 and 1,000 ounces of silver, depending on location. Sound familiar? Jump ahead 2,000 years, 1920s America. Average house price, $3,000. Silver at $1 per ounce. Ratio, 3,000 to 1. Still in the same ballpark once you account for house size and quality differences. The ratio held because both silver and housing were tied to real economic fundamentals. Silver was money. Houses were built with labor and materials priced in that money. The system was anchored to reality. Then, 1964 happens. The U.S. government stops putting silver in coins. Why? Because silver became worth more than the face value of the coin. A silver quarter contained 18 cents worth of silver, but was only worth 25 cents as currency. The market was telling the government their pricing was wrong. So instead of adjusting, they removed silver entirely. That was the warning shot. The moment silver stopped being money and became a commodity, the ratio started breaking. 1971, Nixon closes the gold window. Foreign governments had been exchanging dollars for gold because they knew the U.S. was printing more dollars than it had gold to back them. When France and Germany started demanding physical gold, Nixon panicked and ended the convertibility. The dollar became pure fiat, no backing, no anchor, just trust in the government. And the markets reacted violently. Gold went from $35 per ounce in 1971 to $850 by 1980. That's 2,329%. Silver went from $1.40 to $49. That's 3,400%. Why? Because when you remove physical backing from money, people flee to physical assets. The ratio between silver and housing compressed dramatically. In 1970, the average house was $23,000, silver at $1.70. You needed 13,529 ounces. By January 1980, houses hit $47,000, but silver hit $49. Now you only needed 959 ounces. The ratio compressed 93% in 1 decade. People who held physical silver during that period could trade roughly 1,000 ounces for an entire house. That's not a coincidence. That's monetary physics. When fiat currency loses credibility, hard assets reprice violently, and the silver-to-housing ratio reverts to its historical mean. It happened in Rome. It happened in Weimar Germany. It happened in 1970s America. And it's about to happen again. But this time, it's going to be bigger. Let me show you why. The 1980s crisis resolved itself. How? Paul Volcker became Federal Reserve Chairman in 1979. He raised interest rates to 20%. 20%! Mortgages hit 18%. The economy crashed. Unemployment spiked. But inflation broke. The dollar stabilized. Confidence returned. Silver collapsed from $49 back down to $10 by 1982. The ratio expanded again. By 1985, houses averaged $75,000. Silver was at $6. You needed 12,500 ounces again. The crisis passed, and the ratio returned to its distorted modern norm. Why? Because the system held. The Federal Reserve had credibility. They could raise rates high enough to defend the currency. They could inflict pain to restore order. Here's the problem. They can't do that anymore. The math won't allow it. In 1980, U.S. national debt was $907 billion. Today, it's $36 trillion. In 1980, debt to GDP ratio was 31%. Today, it's 123%. In 1980, annual interest payments on the debt were manageable, even at 20% rates, because the debt was small. Today, annual interest on the debt is $1.1 trillion at an average rate of just 3%. If rates went to even 10%, debt service would consume the entire federal budget. Social Security? Gone. Medicare? Gone. Defense? Gone. Everything goes to interest payments. And it still wouldn't be enough. The Federal Reserve is trapped. They cannot raise rates high enough to defend the dollar without collapsing the government financially. And the market knows it. That's why gold is hitting all-time highs. That's why silver is quietly climbing. That's why the smart money is moving into hard assets. They see what's coming. The ratio is going to compress again. But this time, when it compresses, it can't uncompress because the system can't be fixed. The debt is too large. The obligations are too massive. The currency has nowhere to hide. Look at what's happening right now. The median U.S. home price is $417,000. That's up 47% since 2020. 4 years, 47%. But wages barely moved. How are people affording these houses? They're not. They're borrowing at historically low rates with historically high debt loads. The average American now carries $104,000 in total debt. Mortgages, credit cards, auto loans, student loans. Debt everywhere. And housing prices kept climbing because cheap money flooded the system. But here's where it breaks. Inflation is forcing the Fed to keep rates higher. Mortgage rates hit 8% in 2023. Home sales collapsed. Inventory piled up. But prices didn't crash. Why not? Because sellers won't sell at a loss, and buyers can't afford to buy. The market froze. It's a standoff. And standoffs don't last forever. One side breaks. Either prices collapse to meet buyer affordability, or the currency collapses and prices go parabolic in nominal terms. Guess which one the government will choose. They will print. They always print. Because collapsing home prices means collapsing bank balance sheets, means collapsing pension funds, means collapsing state and local tax revenues. The entire economy is built on housing values staying elevated. So when the choice comes between defending the currency and defending asset prices, they'll sacrifice the currency every single time. And when they print, silver explodes. Now let's talk about silver specifically. Why silver and not just gold? Because silver has a unique characteristic that makes it far more explosive than gold during monetary crises. Silver is both money and industrial metal. Gold is just money. Gold sits in vaults. Silver gets consumed. Your phone has silver. Your car has silver. Solar panels devour silver. Medical equipment needs silver. Every technology defining modern life requires silver, and we're using it faster than we're mining it. 2024 silver deficit, 148.9 million ounces. That's the fourth consecutive year of deficits. We're draining above-ground supplies. Recycling can't keep up because most silver gets used in such small quantities in electronics that it's not economical to recover. It's gone, and demand is accelerating. The solar industry alone is projected to consume 85 to 98% of global silver reserves by 2050, according to University of New South Wales research. But we don't have until 2050. The crisis is happening now. COMEX silver vaults held 80 million ounces of registered silver available for delivery in October 2024. By December 2025, that number dropped to 43 million. That's a 46% decline in 2 months. On November 17th alone, 13 million ounces withdrawn in 1 day. That's not normal market activity. That's a bank run. Physical silver is vanishing from the system, and when physical vanishes, paper price becomes meaningless. Here's what most people don't understand. The silver market trades on paper contracts, futures, ETFs, certificates. For every ounce of physical silver, there are estimates of 50 to 100 paper claims. Everyone assumes they can convert their paper to physical anytime they want, but they can't. There isn't enough physical to honor all the claims, and people are starting to figure this out. Silver is currently in backwardation. That means spot price is higher than futures price. In a normal market, futures cost more because you're paying for storage and time. When spot is higher, it means people are desperate for physical now and don't trust future delivery. That's a screaming alarm. The same thing happened before the 1980 silver spike. Backwardation appeared in late 1979. By January 1980, silver had doubled. The same thing happened before the 2011 spike. Backwardation in 2010. Silver went from $17 to $49 in less than a year. And it's happening again right now. The pattern is repeating. And this time, the fundamentals are far worse because the industrial demand is far higher and the supply deficit is far deeper and the currency crisis is far more advanced. So let's do the math on the ratio. Current median home price, $417,000. Current silver price, $31. Ratio, 13,451 ounces. Historical crisis ratio, roughly 1,000 ounces. For the ratio to compress back to 1,000, one of three things has to happen. Home prices drop to $31,000. Not happening. Silver rises to $417 per ounce. Possible. Or some combination where homes drop slightly and silver rises dramatically. Most likely. Let's say homes drop 20% during a crisis to $333,600. That's painful, but not unprecedented. 2008 saw larger drops in many markets. For 1,000 ounces to equal a house at that price, silver needs to hit $333 per ounce. That's a 10x move from current prices. Sound impossible? Silver moved 35x from 1971 to 1980, from $1.40 to $49. And that was without the industrial demand we have today. And that was without the supply deficits we have today. And that was without the debt levels we have today. But let's be even more conservative. Let's say the ratio only compresses to 2,000 ounces per house instead of 1,000. Still a massive compression from 13,451. Houses at $333,600. Silver needs to hit $167 per ounce. That's still a 5x move. And historically, that's the low end of what happens during currency crises. The ratio wants to compress because the ratio reflects reality. It reflects the true relationship between physical assets and the labor and materials required to build a home. When money is sound, the ratio stays stable because money accurately prices both silver and housing. When money becomes unsound, the ratio distorts because paper claims disconnect from physical reality. But physics always wins. Reality always reasserts. And the snapback is violent. That's where we are right now. Maximum distortion, maximum instability, maximum opportunity for people who position correctly. Now, here's the critical part. This isn't about timing the peak. Nobody can time the peak. The Hunt brothers tried to time it in 1980 and lost everything because they used leverage and paper contracts. What matters is recognizing the direction. The ratio is going to compress. The only question is how fast and how far. And the answer to both is probably faster and further than anyone expects. Look at historical examples. 1971 to 1980, 9 years. Silver from $1.40 to $49. Housing from $23,000 to $47,000. The ratio compressed 93%. If the same magnitude happens again from today's ratio of 13,451, we'd compress to 941 ounces per house, almost exactly 1,000 ounces. That's not a coincidence. That's the mathematical equilibrium that markets seek during currency crises. Venezuela provides a modern example. Before their currency collapse in 2013, the silver-to-housing ratio was similarly distorted because the bolivar was overvalued. As hyperinflation hit, anyone who converted bolivars to physical silver or gold preserved their wealth. Those who held cash or bolivar-denominated assets lost everything. Real estate priced in dollars or ounces of silver held value. Real estate priced in bolivars became worthless. The ratio compressed as the currency failed. Zimbabwe, same story. Weimar Germany, same story. Argentina, same story. Every single fiat currency crisis follows the same pattern. Hard assets reprice violently relative to currency, and the silver-to-housing ratio compresses toward its historical mean. The United States is not immune to economic physics. The dollar is not special. It's just the latest in a long line of fiat currencies that eventually fail. And when it does, silver will reprice just like it always has. So what does this mean for you specifically? It means if you acquire 1,000 ounces of physical silver now, while the ratio is distorted, and hold it through the compression, you're positioning yourself to potentially trade that silver for a house. Not a down payment, the entire house. That's the power of understanding this ratio and acting while most people are blind to it. But this only works if you own physical silver, not paper silver, not ETFs, not mining stocks, not futures contracts, physical metal in your possession. Because when the crisis hits, paper claims will be settled in cash or not settled at all. The people holding paper will get dollars, and those dollars will be worth far less than expected. The people holding physical will have actual leverage, actual negotiating power, actual wealth. Think about the psychology during a housing market collapse combined with currency crisis. Homeowners are desperate to sell. They need to raise cash. They need to pay debts. But nobody has cash, or the cash isn't worth anything. But you walk up with 1,000 ounces of physical silver. Real money, fungible, globally, accepted everywhere, no counterparty risk. That seller will take your offer, because silver holds value when currency doesn't. That's how the ratio compresses. Not through central planning, but through millions of individual transactions where people flee from paper to physical. And here's the beautiful part. You don't have to wait for the full crisis to benefit. As the ratio starts compressing, even early in the process, your purchasing power increases. Say silver hits $100 and houses drop to $350,000. The ratio is now 3,500 ounces. Still distorted, but improving. Your 1,000 ounces is now worth $100,000. That's a substantial down payment on a house or outright purchase of a smaller property. You've already won. If it continues to compress further, you win more. But you don't have to perfectly time the peak to benefit enormously. Now let's address the obvious objection. What if silver doesn't go to $300 or $400? What if it only goes to $75? You still win. At $75 per ounce, your 1,000 ounces is worth $75,000. That's a 142% gain from today's $31 price. Buying at $31 per ounce means your total investment for 1,000 ounces is $31,000. If silver merely doubles, you break even on a down payment for a house. If it triples, you're ahead substantially. The risk-reward is asymmetric. Your downside is limited. Silver has industrial demand floor. It's not going to zero. But your upside is enormous if the ratio compression happens. Compare that to other investments right now. Stocks at all-time highs trading at valuations only seen twice before, 1929 and 2000. Both times preceded crashes. Bonds paying negative real yields after inflation. Real estate already priced at levels most Americans can't afford. Cash losing purchasing power at 4 to 7% annually. Where else can you deploy capital with limited downside and potentially 10x upside? The silver housing ratio trade is one of the only asymmetric opportunities left. And you don't have to go all in. This isn't financial advice. This is education on historical patterns. But consider allocating 10 to 20% of your investable assets to physical silver specifically for this ratio compression trade. That's enough that if it happens, you benefit substantially, but not so much that if something unexpected occurs, you're destroyed. Balance is critical. Greed kills, but so does inaction. Here's how to think about acquisition. 1,000 ounces is the target. At current prices, that's $31,000. For most Americans, that's achievable over time, even if not all at once. Buy 50 ounces per month. That's $1,550 per month. In 20 months, you have 1,000 ounces. Can't afford $1,550 per month? Buy 25 ounces. Stretch it to 40 months. The point is, accumulation while the ratio is still distorted. Dollar cost average if price volatility worries you. But keep accumulating physical. Buy recognizable forms. American Silver Eagles, Canadian Maple Leafs, Austrian Philharmonics, bars from major mints like Engelhard or Johnson Matthey. Avoid collectibles. Avoid numismatics. You want silver content, not collector premiums. When you go to trade silver for a house, you want the seller to immediately recognize what you're offering as legitimate. Generic rounds and recognizable coins do that. Rare coins create questions and friction. Store properly. Home safe bolted to floor and wall studs. Bank safety deposit box, if you trust the bank, but recognize during a crisis banks may limit access. private vault storage if you prefer, but make sure you control access. No third-party custodians where you don't hold keys. The entire point is removing counterparty risk. Don't reintroduce it through bad storage decisions. And understand the timeline. Nobody knows exactly when this compression happens. Could be 2 years, could be 5 years, could be 10. But the direction is clear. The ratio will compress because the fundamentals demand it. The currency is failing. The debt is unsustainable. The physical silver supply is draining. Industrial demand is accelerating. Housing is unaffordable. All vectors point toward compression. Your job isn't to predict the exact month. Your job is to position yourself before the crowd realizes what's happening. Remember, the Hunt brothers were right about the direction. Silver did go to $49. The ratio did compress to under 1,000 ounces. They failed because they used leverage, and the exchange changed the rules on them. Learn from their mistake. No leverage, no paper, no gambling with futures contracts, just physical accumulation and patience. Let the market come to you. And when the compression happens, don't get greedy. You don't need silver to hit $500 per ounce. You need it to hit the point where your 1,000 ounces gets you the house you want. That might be $250 per ounce. That might be $350 per ounce. Depends on the house. Depends on the market. But when you hit your number, execute. Trade the silver for the property. Lock in the gain. Don't hold out for the peak because peaks are impossible to identify in real time. The Hunt brothers held out and lost billions. Be smarter than they were. The other side of this trade is just as important. What happens to people who don't position in silver? They're stuck holding depreciating currency or inflated assets. Their 401k might go up nominally, but if a gallon of milk costs $15, who cares that your account grew 8%? Your purchasing power still declined. Housing might go up nominally, but if your mortgage payment takes 60% of your income instead of 30%, you're poorer, not richer. Nominal gains mean nothing during currency crises. Only real purchasing power matters. And silver, measured by the housing ratio, is one of the clearest measures of real purchasing power we have. When 1,000 ounces buys you a house, silver is strong and currency is weak. When 13,000 ounces buys you a house, silver is weak and currency is temporarily strong. Right now, we're at peak distortion. That's the opportunity. This pattern has played out over and over again throughout history. Those who recognize it early build generational wealth. Those who ignore it watch their wealth evaporate. You're being given the same choice right now that Americans faced in 1971. The same choice Romans faced when their currency was debased. The same choice every civilization faces when their money fails. Convert to physical or stay in paper. There is no third option. The clock is ticking. Every month, the Fed prints more dollars. Every month, the deficit grows. Every month, the debt compounds. Every month, physical silver gets consumed by industry and withdrawn from vaults. The ratio is under maximum tension, and when it snaps, it will snap fast. By the time the mainstream media is reporting on the silver housing ratio compression, it will be too late. Premiums will be massive. Dealers will be sold out. You'll be competing with millions of others who finally woke up. That's always how these patterns play out. Slowly, then suddenly. For years, nothing seems to happen. Then, in a span of months, everything changes. 1971 to 1980 felt slow at first. Then suddenly, silver was at $50, and houses were affordable again for those holding metal. The people who accumulated from 1971 to 1976 made fortunes. The people who waited until 1979 paid massive premiums and barely benefited. The people who did nothing watched their savings evaporate. Which group will you be in? The early accumulators who recognized the pattern, the late chasers who paid too much, or the bystanders who did nothing and lost everything. This isn't a sales pitch. I don't sell silver. I'm showing you historical data and mathematical ratios that Wall Street ignores because it's inconvenient to their paper asset business model. They want you buying stocks and bonds and ETFs that generate fees. They don't want you buying physical silver you can hold in your hand that generates no fees and removes your capital from their system. But your goal isn't to make Wall Street rich. Your goal is to protect and grow your own wealth. And the silver housing ratio is one of the most powerful tools available to do exactly that. 1,000 ounces of silver will soon buy you a house in the United States. Not because I say so, because the math says so. Because history says so. Because the pattern is repeating right now in real time. The question is whether you'll act on this knowledge or dismiss it. Whether you'll position yourself for what's coming or stay stuck in the system that's failing. The ratio is screaming. The vaults are draining. The currency is dying. And the window of opportunity is closing. Don't be the person standing there 5 years from now watching silver at $300 per ounce and houses being sold for 1,200 ounces, wondering why you didn't act when it was obvious. Be the person who saw the pattern, trusted the data, accumulated the silver, and secured generational wealth for your family. The choice is yours, but the math doesn't lie, and history doesn't forget. 1,000 ounces of silver will soon buy you a house. Position accordingly. If this resonated with you, if you see the pattern, if you understand what's coming, subscribe to this channel right now. Hit that subscribe button, because what I've shown you today is just the beginning. The silver housing ratio is one piece of a much larger puzzle. In upcoming videos, I'll break down the debt spiral, the currency collapse timeline, the coming banking crisis, and exactly how to position yourself for maximum protection and profit. This is the most important financial education you'll ever receive. Don't miss the next video. Subscribe now. And drop a comment below. Tell me what you think about the silver housing ratio. Are you already accumulating? Are you skeptical? Do you see the pattern playing out? What questions do you have? I read every single comment, and I'll answer as many as I can. Let's build a community of people who understand what's happening and are taking action. The people who see clearly will be the people who survive what's coming. Comment below and let me know you're one of them.